Today, I'm going to show you guys two opening range break strategies that you can utilize right away in your day trading. One of them is how a lot of traders use it, and the other is how I use it. Mine only has a small difference, but I do think that it brings a lot of impact to the play, and I'll tell you why when we get to that point. But I want to cover just one thing, and my goal is to stop rambling in the beginning of these videos and just get into it so you guys aren't bored. But I feel like I need to say this. When you're trading, you have to get a strategy that you can follow. Everybody knows that. You need a strategy daily that when you see it on the chart and it presents itself, you know that you've back tested it, you've studied it, and you know that that strategy has presented itself and there's a play there. But you also have to understand 5 days a week, there is not a play that presents itself on anything most of the time. So I trade ES futures in the morning, New York session open on the 5-minute opening range break. 5 days a week, I do not get a trade. I don't get to trade every single day using my strategy. If you are the kind of person that thinks when you go to bed at night, I can't wait to wake up tomorrow morning and make a whole bunch of money. I think that sometimes, but I don't wake up knowing that that day I'm 100% making a trade because I don't dictate what happens on the charts. If the strategy doesn't present itself, I just simply don't trade that day. I just don't. There are some weeks where I only trade 1 day a week, and that sucks. But when I do that trade and I follow my strategy on my real money accounts, I make $1,000. I know you guys see a lot of videos that I post because I'm doing demo accounts and I'm trying to show you guys how you can get funded accounts going. So I trade more that way. But when it really comes down to the brass tacks here of my money, my real account, not a funded account, real money that I've put $25,000 into of my hard earned dollars, I only trade that account 1 day a week, sometimes two, maybe three. But there is zero chance that that account is getting traded 5 days a week because the trade doesn't present itself that often. So if you ever tell anybody I'm a day trader and they look at you and go, "Oh, you like gambling?" If you're someone who trades 5 days a week and says you have a strategy, you are a gambler. You are not a trader. If you have a strategy that presents itself 5 days a week, please send it to me because I would love to verify it because I don't think it exists. Now, let me show you the two opening range break strategies, the one that most people use and the one that I use, which is a small little addition that I think makes it better. All right, so we're looking at NQ this morning, full contract NQ. This is for today, which is November 4th, 9:09 a.m. Pacific Standard Time. So right here, this is the 5-minute opening range break, and you can see here that it's marked with the opening range high and low. And this filter or indicator, excuse me, that I'm using is the key levels indicator. This one right here, exactly by Liquid Trader. It's 2.5 thousand saves, favorites, reviews, all that stuff. It's the best, I think. If you guys want to see the settings on this, you'll uncheck a couple boxes in here, click opening range, change it to 5. This will automatically set right here on the 5-minute opening range break. And then at the very bottom, you need to set your time zone. The New York session starts at 9:30 a.m. and ends at 1600, and you need to have New York as your time zone here so it can correctly allocate on the indicator. Now let's talk about how most people trade the 5-minute opening range break. This is a classic setup right here. You get the opening range break, it's bearish. You get this candle here coming back, you get another big candle, and you break out of the zone, right? You break out of your opening range break high. That's the point of the strategy. Orb, opening range break. We broke it right here. Now, a lot of people just go in right here, and that's fine. In this scenario, that would have been fine. But a patient trader waits for the next candle to close, okay? So the candle body is really small, but it's still closed outside. So if I were trading the way they trade, I would have went in right here. And let's just be ultra conservative and say I would have went in right here in the middle of this body. So let's take our long position because we're bullish. Now, this is where you can decide, do you want to set your stop loss at the midpoint? Do you want to set it just below the zone? Everyone does this a little bit different based on their level of risk. In this scenario, I probably would have went to the middle point, and is what that would have meant would be if this auto corrected right back down into the zone, I would have had an opportunity to be like, hey, this is moving quick. I can get out here and just preserve a little bit of money, or I let it play out. Maybe it comes down and takes my zone, but I know that I just made a bad read and that's what it is. Here's where the problem with that comes though, is that I target at least a 1-2 risk to reward. So if my stop here is at 61.5, to get a 1 to 2, this has to be 120, what, 123. So I have to set it up here, and you can see with the chart movement that it did, I would not have ticked out. I would not have hit my take profit, so I would not have hit my 1 to 2. So a lot of traders will set it just below the opening range break high in case it does rebound and ticks down. They don't take a ton of loss, but if it touches the zone and buyers immediately push it back, then they're good. And you can see on this one, this would have been 29.5, let's just call it 30. You would have then set your stop loss at 60, or excuse me, your take profit at 60. You would have, like, immediately in the 5 minutes going into the trade, you would have ticked out and you would have doubled your money. Let's say this was $300, this was $600. You would have made $600 on this trade, but it would all depend on where you set your stop loss and if you truly are targeting a true 1 to 2 risk to reward. So you can see how that scales. If your risk was all the way down here of like, I want to make sure to win, 111, you'd have to up here to 222. I mean, you'd be, so no one would do that. No educated trader would do that. But it depends on where you set it. I would go midpoint. I would not have hit here. Someone who goes right here would have hit. Now, let me show you what I do. I run this other indicator called a fair value gap. So when a fair value gap is here, I wait for this to happen. So if this is going up on the way, there actually is a fair value gap right here that's not showing up, because you can see wick right here stops, but this has already overtaken it. So if this was here, the fair value gap would be right here. Let me just line it, or I'll rectangle it out for you so you can see. Right here to right here, before this overtook this part, there was a fair value gap right here. So that would have been a positive for me. I would have seen this went up, then this, well, the second candle, because a fair value gap is created between 3 candles, and there has to be a gap between wicks and a body of another candle for a fair value gap to be created. So if you look over here at this one, there's a wick right here, a big bodied candle, and then another wick. So this fair value gap is the difference between this wick on candle 3 and this bottom wick on candle 1. And then the body of candle 2 is where that fair value gap is created. And essentially there's liquidity just sitting here that never got taken back. So on this side, now that we're doing this after the fact, this liquidity has already been taken now on the way back down. So again, 5-minute opening range, bullish candle, fair would have been created off of this second one. I also would have went in right here because a fair value gap would have been behind it that never got reclaimed. If the fair value gap would have been taken here and it did not present it, I would not have traded this. I don't trade just an opening range break. I like to see that on the way up, some liquidity was left behind because I know eventually it's going to be retaken, but it just shows me with a gap right here of strong liquidity that didn't get taken, sellers aren't in control because they didn't reclaim that. If sellers were really battling this move, they would reclaim those gaps and take the liquidity, so that wasn't an option. So that would give me an extra layer of confidence knowing fair value gap never reclaimed. Boom. I would have also entered here, but I would have lost because I would have went to the midpoint with it just being outside the opening range break. I wouldn't have hit my profit on this. I know that if I stuck to my strategy, which I hope I would have, I would have lost actually technically over here. So let's just look at one other example. One of those can be from yesterday. So this actually was a trade that I took, and my key level indicator isn't going to go off because it only goes on current day. I don't have it set to go back. So this right here is the 5-minute opening range candle, 5-minute break. Massive fair value gap right here. Another massive fair value gap right here. And honestly, yesterday I entered this trade about right here. So somewhere in here in this range. So let's just split the difference in the middle. So is what I did yesterday was fair value gaps were everywhere. I put my stop loss right here at the bottom, which was 11 points, or let's call it 12 for the sake of the video. And then I had this down at 24. And you can see like 25 minutes later, it ticked out and I hit my take profit. So yesterday I entered mid candle here somewhere. Maybe I was higher end, maybe I was lower end. Even if I was lower end, you can see here, even if I was down here, this big candle right here would have paid me out, which it did. So somewhere in here I entered, I had my stop loss set right at the bottom of the zone. That way, if it did start to rebound, I would see if there was some defense here and it kicked back down. But this is one, again, both options would have won, because the minute you break out of the opening range break, big candle closed, any other trader who's not waiting for a fair value gap would have entered right there. And they would have won. A fair value gap was presented. I entered here. That one won as well. So that's just kind of the few examples. I wait for fair value gaps, and every time I wait for one, they've proven me right. It just depends on how aggressive I set my 1 to 2 risk to rewards. So both days, both options would have presented themselves. And yeah, so those are kind of the two opening range breaks off of the first 5 minute candle that you can use to operate if you don't have a strategy. This is a very simple one, and it's very easy to follow.